It's definitely competitive for sure. There is a lot of money coming into the space, but it's an attractive asset class. Yields are attractive, especially with base rates where they are today, and I think you've seen a lot of money come into the space on the basis of that, but also because it's a really good risk-return proposal for our investors.
If you say attractive yield levels, what yield levels are you actually targeting? We know from the equity side of things that it's roughly 20%, so what is your target?
We target more in the low teens, mid-teens levels.
So let's look at the industries you are currently lending to, and also the players perhaps involved. Do you see a trend here evolving?
Absolutely. Like if you look at the private equity industry, there's about $2 trillion dry powder that we're sitting on right now. The private credit industry has been mirroring that expansion. And I think as we evolve over the next 5 years, private equity will continue to grow, as will private credit. Our approach is we're looking to lend senior secured loans to companies that are backed by private equity sponsors. So in fact, mirroring that ecosystem.
Deal activity is probably also a main driver of your business, and that has been slow last year, over the last years, I should say.
Yeah.
Is that expected in your view to pick up soon?
I think there's a lot of tailwinds that point to it picking up soon, whether that is Q3, Q4, Q1 next year. But if you think about the level of capital that needs to be deployed by private equity, there is naturally a case made for fundraising, must distribute money back to LPs, need to acquire and sell companies. So once the bid-ask spread narrows between buying and selling companies and people are at a point where they can agree deals, we'll see deal flow re-engage. We're starting to see some of that already. I think people are gaining in confidence in terms of their view of base rates, what that looks like over the next 12 months, and what they can achieve for their portfolio companies on exit.
Do you think like other uncertainties, macroeconomic uncertainties, are also weighing on like sentiment when it comes to daring to do acquisitions?
To some extent, but when you think about how we underwrite a credit with a variety of scenarios in play. So we're looking for, the base case, what could go wrong, what's our second way out in this instance. So we like to play for the longer game. We want to understand, to the best that we can, all eventualities. We want to be weatherproof, if you will, right? So it's a case of, the base rate being high, does that put you off actually, putting debt into a business that you're acquiring? Well, no, they're floating rate loans. We all understand that the base rates in various jurisdictions will reduce over the next however many months, quarters, years. So it's a case of when those loans then, they will also reduce in terms of serviceability. So I don't think those things hold it up. I think people are very aware. They're very aware of how those economic factors will feature into the underwriting of the businesses from a loans perspective, but also from an equity perspective and how they make their upside.
Yeah. The higher for longer rate environment, of course, is a big topic here on the ground as well. So how is it affecting your business?
Well, it's twofold for us. From the investor side, we're obviously delivering very nice returns for our investors, given the base rates are higher and it's a floating rate product. On the other side of things, we have to be quite cautious when we underwrite businesses. Can they support this level of debt that we're putting in? Can they service the interest payments? And that's something that we spend a lot of time, making sure that the actual robustness and the resiliency of those businesses is very real and something that we can stand behind. Because we're not distributing this debt, we're holding it for the long term.